All right, welcome back to the I Love Annuities podcast. I am Jeremiah Conger, along with our co-host Zachary Van Ness, and we are the Annuity Dudes. And if this is your first time joining us, we're thrilled to have you here. If you've been following our series, then you know that we're diving deep into the world of annuities, retirement income strategies, safe growth strategies, and all things related to securing your financial future. In the last episode, we've covered the basics of annuities, from understanding what they are to how they can be used as a tool to create predictable income in retirement. If you haven't had a chance to listen yet, go ahead and check that out first. But in today's episode, we're going to be even more critical for those of you who are looking for one thing, and that's guaranteed income in retirement. That's the most popular reason annuities are applied to a retirement plan, and that is to secure guaranteed incomes for life or guaranteed incomes for periods of time. Now, this is a huge topic for retirees and pre-retirees, especially for those who are risk averse or moderately conservative with their investments. And they want to know that when they stop working and those paychecks from their employment stop coming in, that no matter what happens in the market, that their income and their retirement ultimately are going to be secured. And we're going to explore exactly how to appropriately apply guaranteed income annuities in retirement. We're also going to discuss the intricacies of those types of contracts, go into a deeper dive on the contractual guarantees and the different types of annuities that you can use for guaranteed income. And then we'll back that all up with some supporting research from some of the top PhD experts in retirement income planning. So without further ado, let me introduce our co-host, Zachary Van Ness. He is our senior annuity advisor here at AnnuityAssociation.com. He works with clients in all 50 states to help them understand and navigate the wide world of annuities. How's it going, Zach?
Doing great. How are you? And how's that record button?
The record button's working this time. That's a little inside joke. So we just realized about an hour into recording that I never hit the record button. So luckily, that's what a co-host is for. It's like a co-pilot, right? He helps me navigate. So thanks for making sure. But we got that little red light now that we're recording. So we're good to go.
We are good to go. Yeah. Thanks for joining us again, everyone. So today we'll take a deeper dive into annuities for that purpose of income and the several different ways that we can utilize it.
Yeah, establishing guaranteed income is so important in retirement. It's really a foundational building block of a sound retirement plan. It's all about securing guaranteed income in retirement. And once you do so, the benefits that it can afford one in terms of the peace of mind and the clarity and confidence to allow them to spend what they need to spend to sustain their lifestyle, and really get the most out of retirement, which is really why they saved in the first place. Wouldn't you say, Zach?
Right. That's it. Yeah. By creating that foundation, we've set aside a plan. We've created this plan, and in these finances here, we've allocated what we're going to use towards that lifetime of income and creating the foundation. That just frees up the rest of our life for any other assets that we do have and how we can utilize those assets. So we've used the analogy before. It's just a weight lifted off the shoulders where we know exactly what to expect with one piece of our retirement planning, at least with that guaranteed lifetime income. Because reality is, once we surrender that income paycheck from our career, well, then we're put in a tricky position.
Yeah. And I mean, that's a really important piece right there, is that I ask our prospective clients oftentimes in our meetings, and that is, when's the last time you've ever had to take a withdrawal from your 401k? Most of them have never done that. Most of them don't even know how to do it, right? And when you're looking at this large nest egg of money that you've amassed over your working years, when you're working, you look at that money as just savings, right? But really what that money is for future income once you retire. And having that future income and giving it a contractual guarantee through an income annuity like the ones we're discussing today, it allows you to really enjoy your life in your golden years, really spending more time with loved ones, pursuing hobbies and traveling and doing all the things that you've envisioned doing. But in order to do that, you kind of got to give yourself a ticket, right? Give yourself a ticket to spend. And a lot of people have reservations. A lot of people are hesitant on how to do that. And it's because they don't ultimately have a plan. And most of the time, if they do have a plan, it doesn't immediately have one for guaranteed income. And that's really what we're here to discuss today, is how to exactly do that and what types of annuities you should consider to ultimately do that. Before we kind of go into our segments here, I think it's important to note like how we got here, right? Like how did us as a society get to this point where, a lot of people say, a lot of experts in retirement planning say that we're almost in a retirement crisis. And not because people can't retire necessarily, but people don't know how to retire. There's a lack of education on this arena or this subject matter in financial planning. Financial planning is one aspect, but retirement planning is a whole nother beast. It's a whole nother world of complexities to navigate. And when you really stack up all of the risks that we face in retirement, it really it's uncharted waters. It's something that we don't know exactly how we're going to navigate them, but it comes down to understanding the tools that you have available and how to appropriately apply them in order to mitigate those risks that we face in the future. So if you kind of look back over history, and how we gotten here to this point, there's a thing that we used to call, or is still called this, but something that used to be very common, um, you know, 30 plus years ago, and that is a pension, right? My grandfather retired from Winn-Dixie Supermarkets. He was a produce manager, and he was actually one of the last managers to retire and actually receive a full pension, because shortly after he retired, Winn-Dixie nixed the pension plan and they replaced it with this 401k, right? This thing that everybody knows and has come to love to a degree. And I really believe that it's important to discuss the history and how we've gotten up to this point with really what we're looking at, because this is the first time where there's more money in 401k accounts than ever before. And it's all because the pension was replaced, probably, I guess it's about 40 years ago, over 40 years ago now. So if you look back over time, corporations used to offer their employees pensions. And while pensions were a good thing to a degree, they were also like a handcuff, right? They were a handcuff to people that you had to continue working there, no matter how bad they treated you or how much you hated that job. If you left, you lost your pension. So it was like a handcuff. And while I agree that was a bad thing to have those types of handcuffs and for those corporations to have that type of leverage, really the corporations, as much as you may not think they wanted to get rid of those pensions too. And the reason is they saw the risk that offering that type of plan posed on their bottom line long term, because of all of these uncontrollables and unforeseeables of the future. And you factor that in with people living longer lives and healthcare advancing and so on and so forth. Pension plans are very tough to manage. And these corporations that offered them wanted to get those things off their balance sheet so that they had minimal risk when it came to the future of their company. And that's where the 401k was introduced. So while the government was trying to figure out ways they could move away from the pension, there was a gentleman in the early 70s that came up with the idea of this 401k, and along with his ideas and the government coming in and kind of planning around this 401k, they incentivized people and companies that if they offered 401ks to their employees and the employees contributed, that they would get these tax write-offs. And so now, while the 401k is great, when you leave a company, you can take it with you, it's portable. all of the risks of retirement planning are now on you, and it's on you to mitigate them. And there's many ways to skin a cat, but a lot of those ways are very difficult to stomach, right? To go through. And a lot of that is because of all of the uncontrollables and all of the things that we don't know that may happen in the future. So that's why understanding how leveraging the guarantees of an income annuity in combination with your Social Security and pensions can really, really put together a bulletproof plan to at least address your essential living expenses in retirement. So, Zach, I know you've been working with quite a few people across the states here recently about income planning. Why don't you talk to us about some of the discussions you're having and some of the emotions of those meetings that may come out on the table once you kind of describe what they're potentially dealing with and how to navigate that.
Yeah. And, it's important to know that from the client base that we speak with, it's people from all realms and all different walks of life. So that could be anyone from somebody who has a PhD to an engineer to blue collar worker or a nurse. It's any which way we look at it. And everybody's encountering this journey at a different time in their life, whether that means that they're coming into this 5 years before they plan on retiring, 10 years before they plan on retiring, or they're already retired and they have this feeling of maybe uncertainty, and maybe they waited too long to make a decision. So what I'm seeing across the board, though, is ultimately, granted, the markets have been in our favor, of which nobody had the crystal ball to determine that. We're finding is some concern of how do I manage my monies when I do retire? And how do I give myself a guarantee to cover my expenses for the rest of my life? I'm 65 now, and hey, my mom and dad lived into their 90s, or, there's longevity on my side. And how do I make this money work for me so that I can enjoy the rest of my life and go play pickleball and not have that conversation at the court about the market that day and how it's performed or how it's been negative. And instead of me worrying about, my backhand and hitting it into what is it called? The kitchen.
Yeah.
Instead of worrying about that, now my mind is focused on the S&P and the Dow and how it hasn't performed. And that's not the idea of retirement.
Yeah, that's one thing I noticed too with our clients is that a lot of them enter this new mode, right? This new phase of life as they start to approach retirement, or maybe they've recently retired and it's more of a preservation mode where, they're grasping all of their money with their hands, right? And they don't want to lose it. And with that, they understand that they can't afford to take unnecessary risk in the market, but yet they still need enough growth to provide income in retirement, or at least they think they do, so that they don't dwindle down their accounts prematurely, especially if they plan to or have the possibility of living a longer life. Mm-hmm. And, that's the thing. And I always ask our clients when we talk to them is, back in 2008, how did you look at your accounts then? You were, working still and a lot younger. When that crash in the market happened in 2007, 2008, or even before that in the early 2000s, how did that affect you? And oftentimes they say, well, it didn't. I didn't even look at it. I didn't care. I didn't really care because, yeah, I was contributing to the market, but I knew I had plenty of time on my side for it to come back. And I think that's one of the most important things is that once you start to get close to retirement, time is no longer on your side. Time is something that allows us to bounce back from those downturns in the market. But if you start having less and less time for you to recover from those downturns, you're left with a couple options, especially as you get closer to retirement and you're planning on that nest egg generating retirement income. And those two options you're left with in the event of a downturn is either you retire with less money or you retire with less income from that money. And a lot of people don't want to be in that predicament. That's a really tough situation to be in. And it's one that nobody really has ever had to deal with before. And really it's important in knowing how to offset that and mitigate that risk. And that's where the power of a guaranteed income annuity, when applied with your Social Security and pensions, if you're still blessed to have one in the future, you can really build a monumental approach to the rest of your retirement plan. And that's with that income. And I have a saying that I use often in our business, and that is not that cash is king. That's the old saying, right? But when you enter retirement, income is king. I'm actually going to get t-shirts made. We can wear those on the next episode.
There we go. Yeah.
But income is king. And there's many different ways to get income, but there's only 3 ways to get guaranteed income. Why don't you talk about those 3 ways, Zach?
Yeah, the 3 ways to get that guaranteed lifetime of income is going to come from, those 3 different annuity types.
Well, before the types, right, we're going to talk about those sources of guaranteed income, not just from an annuity. So you have that annuity, right?
Well, I apologize. Yeah. So when we look at the types of guaranteed income, one would come from, would really come from a pension, in which, like you had mentioned, if you're lucky enough to have one, then there you go. That would be one option. And I jokingly put an asterisk on this, would be Social Security. I don't know if you and I are going to be in the position to see it, but fortunately, many others are right now.
Yeah, I just heard, actually, I was listening to a podcast around tax related planning and Social Security planning and things. And the lady that was saying, and she's a genius, by the way, but she was saying that it's not necessarily going to be the baby boomer generation that has to deal with the alterations of the Social Security, the Social Security issues that we have. It's going to be our generation that foots the bill for it.
Oh, yeah.
Which, I totally get it. If that's what has to happen, that's what has to happen. But what she was saying, though, is that she doesn't envision, and she's an expert in this field. She used to work in Washington. But she was basically saying Social Security is not going anywhere. It's just going to have to be, there's going to have to be some alterations made either for future generations or the way that people are taxed today to be able to make the changes necessary to sustain that program.
Yeah. And I couldn't agree more. I mean, from our end of it, we're not 100% sure what we're going to see, and in a position where I'm not going to rely on it, hopefully. So going back to it, so we've got the pension, Social Security, and the last would be an annuity. An annuity which can provide a lifetime of income or for a certain period, and that would be dependent upon what that person's need is.
So if somebody's kind of researching annuities, they're just starting out, or maybe they're just starting out looking at retirement planning, and they're starting with their income plan, what is the best approach for somebody to build that foundational building block of their retirement plan for income? In other words, what's the foundation? Like, how do they learn how to do that? What are some of the steps that they should take in order to determine how much income they need?
Yeah, I mean, the first step in what I practice with any of my clients is figuring out what the expenses are, right? So sitting down, doing the math on it, and actually spending a little bit of time. And I've done this with clients on our meetings, and just some clients will come in more than prepared with their spreadsheets and spreadsheets on top of spreadsheets. And others may not have.
Crowd. I love them.
That's right. And we get a lot of them. But others may come into that meeting and not have actually thought about that yet. And this is a discovery process, and we're here to provide the value that we have in understanding what's important at retirement. And we can take somebody through those steps. But I think the first step is really understanding what those expenses look like and being realistic in what those expenses are. If that means you're going to get out to the golf course once a month, be realistic about it. If you've got a car that's 20 years old and it's on its last leg, we've got to be honest in the situation, understanding that might be an expense down the road.
I think that's important because I have the same conversations with our clients And, we start to talk about this income plan and how much income they need. And we start with these essential expenses, right? And so they'll say things like, well, my mortgage is this, and, my car payment is this, or my insurance is this, and my groceries are this. And I'm like, okay, what else? And they're like, well, that's it. And I'm like, so what are you going to do? Just sit in your house and eat all day? Like, you still are going to go out, right? You're going to go out. Every day is Saturday and when you retire. So you're going to be spending more money. You're going to be doing more things outside of your home and outside of the four walls. And most oftentimes you're going to be spending more money. And so, like you said, let's be realistic. If you have a hobby, whether golf or boating, fishing, pickleball, whatever, make sure that you factor that in. Be realistic. Obviously, we don't want to live beyond our means. That's the golden rule. But we also don't want to live life in retirement miserable, right? Doing the bare minimums. Nobody wants to do that. And when you have all this time on your side now, free time, being that you have all this extra time, you're definitely going to be wanting to do things a little bit more than you used to. So the extracurriculars definitely need to be a part of the budget.
Yeah. And by not having a plan in place, it takes away from the enjoyment. I mean, if we go into our work day without a plan in place and you're just scratching, trying to figure out what to do for the rest of the day, and you're playing catch up all day. And I think that also carries over to retirement. Without having a proper plan in place, you're worrying about it constantly. And what have you now encountered in retirement? Nothing but time. So now you've got nothing but time to think about the decisions that you haven't made yet.
Exactly. And so you're going to start with your budget, your monthly expenses, and then what are you going to do then? You're going to add in what your expected incomes are from Social Security and a pension. And then where does that annuity come in?
Yeah, that annuity, and a term that we use is to fill the gap. We're not trying to, an annuity shouldn't be used for the purpose of putting all of our assets into this one bucket, right? It's as much as is needed and as little as necessary. You use that all the time. So really what we're trying to do is bridge that gap of the income that we don't have to cover the expenses. And then we find other goals and missions behind the other assets that we do have.
Yeah, I think that's important to note too, is if anybody is ever telling you to put all your money in annuities, do yourself a favor and run, because that's not prudent. That's not the right way to approach this. An annuity is a tool just like anything else out there, and it needs to be appropriately applied in order to get the most out of it and have it have the most positive impact on your financial future. So yeah, it's as little as possible, but as much as necessary in that, from that income perspective, right?
Right.
And, it's all about having enough of that income guaranteed between those three sources to cover your expenses so that you can sustain the lifestyle that you've built. And once you've been able to do that, the peace of mind and the clarity and confidence that are byproducts of that proper planning to give you the ability to look out into the future and know that you're covered no matter what happens with the uncontrollables of the market. That's really a very powerful sentiment to have. And in addition, the power that planning does to allow people the ticket to spend as much as they need to every month up to that budget, right? And do so almost guilt-free. Think about that. Think about the way that makes you feel. Think about the way that it gives you the ability to plan your life accordingly, knowing that you can do the things that make you happy, do the things like spending time with your loved ones or going out to dinner, or playing 18 holes or whatever it might be. The annuity is like the ticket to spend because it's an unlimited income, not unlimited from a dollar per month perspective, but out into the future, you can spend that same amount an unlimited number of years. And that's where that guarantee for life comes into play.
That's right. And that's really where it comes into the importance of meeting with a retirement specialist and an expert in this field. And this isn't just you and I talking about experiences that we've had. This goes back to PhDs and experts in the retirement field and their opinions to that and the research that they've done to come up with this.
Yeah, there's a couple PhD experts that we're very fond of here at Annuity Association. We'll talk a little bit more in depth to their research and some of that. But Dr. Wade Pfau and Dr. Michael Finke has really been impactful or instrumental rather to the world of retirement planning. And they've done everything from researching just keeping your money in the markets with a diversified portfolio to inputting income annuities or protected growth annuities. They've done all the research, and unanimously, all of those PhD experts that have done that research, they all agree that having an income annuity, and they back it up by the research, it's proven to have far more optimal outcomes in retirement. And we find that that's what people want the most.
Yeah, without a doubt.
You talk about, not just a bottom line economical perspective, but the psychological perspective that the power of guaranteed lifetime income with an annuity in combination with Social Security, and again, a pension if you're blessed to have one, the power that gives you of peace of mind and what we call the psychonomics of financial planning, it's unmatched. It's hard to really place a value on the peace of mind. And I know you've mentioned it earlier, Zach, when we were recording without hitting the record button, but it's all about that power of guaranteed income and the clarity that it's giving somebody, and the ability to know that their future from a financial perspective is certain and they're alleviated from all of those risks that they don't know that they might face, if they might face them.
That's it. So there's no stress going into the day to day. I had made the comment about being able to get on the pickleball court and enjoy life a little bit more without the concern of this group over here, these couple guys talking about the markets and what their money's doing or not doing. Just gives you some certainty and knowing what to expect. And whether that means that's certainty for just yourself, you individually, or for you and your spouse, it goes a long way.
Yeah, and I think that's the most important part, is not only planning for ourselves, but planning for our spouses. I know that the demographic that we generally serve the most, that being the baby boomer generation, it's very common that, the husband is more involved in the finances than the wife is. And totally fine. It's not always that case, but majority of the time it is. And I think it's very important to note that an annuity can be such a powerful tool for someone to help mitigate the loss of a loved one, especially either the primary breadwinner or at least the person most involved in the finances. And it allows them to really plan for that day and that horrible, that horrible day that might come in the future, and allow that loved one to have enough time to mourn and get all of their thoughts together and all of their other things that they need to tackle when that event happens. And the income annuity and the role it plays to serve that surviving spouse is really and truly unmatched. It gives that person peace of mind and that they're going to be taken care of. And not only that, but it allows the husband in most cases, right, the peace of mind that if that day happens, that their loved one is taken care of too, and in the time that they need it the most.
Yeah, I'll tell you, we talk a lot about our client interactions and what feedback we get. And I just did a 1-year review with one of my clients, and he was just reiterating to me, number one, why we did this. It was for that guarantee of income for he and his wife. And that's, now so that they can utilize that and enjoy retirement. But ultimately the big value that this put on for him, he came back and thanked me and said, this is providing something to my wife that I otherwise couldn't offer her. And
that's powerful, man.
The peace of mind that it gives him, as a spouse, we're always looking out for our significant other. That's always the main priority, but especially financially. And like you had mentioned, oftentimes we see that, whether it's the man or the woman taking over in the financial role, the ultimate goal is that we can provide for the other person if we're not here.
100%.
And that's what we see there in that situation, but oftentimes with most of our clients.
Yeah, I know. And I always commend the people that come onto these meetings, because let's face it, right? They're not always the most comfortable situations. Like they're having these in-depth conversations with, initially strangers, right? You and I, they don't know us that well, if at all.
Yeah.
And they're sharing with us these important things and talking about future scenarios. And a lot of times it involves death, right, of a loved one, and the planning that needs to be put in place to help mitigate those risks. And I always commend the husband, usually, if it's the husband usually, or the wife, whoever's doing it, I commend them for taking that step, because it has such an impact. It's such a true statement of, that person that's doing this for their loved one. It's a true statement of love. It's a true statement of commitment. It's a true statement that, till death do them part, right? That they're going to take care of them. And the annuity is such a powerful tool, because it allows someone to take care of them even after they're gone. And there's nothing more powerful than that. And it brings up a kind of sensitive subject, because it just happened the other day for me. But I got a call, the call that all of us as advisors never want to receive, right? But we know it's inevitable because it's life. But I got a call on Monday, which was just what is today? That was yesterday. Shoot. And it was from one of my clients, and it was the wife, and she gave me that dreaded information that I didn't want to hear. I could hear it in her voice when she said my name, and she said, Jeremiah, she said, Paul died. Paul died on Saturday. And I had known that he was sick. And this is one of our clients. He had bought an annuity about a year ago, and we did the planning. We did the whole risk mitigation of a surviving spouse, what we can do to help that blow from a financial perspective. And, he was a doctor. He was an urgent care doctor. And we're talking about a guy that literally specializes in health. And he called me about 2.5, maybe it was right around Christmas time, just before Christmas. So I don't know, 2.5 months or so, 3 months ago. And he called me and he told me that he was sick. And I could hear it in his voice that he was really upset. And I said, well, what do you mean? What do you mean that you're sick? And he said, the doctor just told me I have less than 3 months to live. And, it's a thing that I'm getting chills right now just thinking about that conversation, because like, what do you say to somebody when they tell you that? Right. And this is, again, a doctor that had practiced medicine for 40, at that time, probably 50 years. He was in his late 60s, I think. And he told me that he had some rare disease, like less than 200,000 cases ever in history, or something like that, in the world. And it was something to do with his plasma cells and proteins that were building up. And basically these protein deposits were causing harm to his organs and shutting them down, and the body couldn't react fast enough. And so, long story short, I didn't expect him to go that quick, even though he told me, and obviously he's an expert. And I told him the thing I told him the most was, get the most out of every day that you can right now, and be strong for Sandra, know. And that's a tough conversation, but his wife called the other day, and she was frantic. And what's kind of interesting when you get that conversation, that call, is at first they seem like they got it together, right? And they're like, oh, this just happened. It's almost like they're in a sense of shock. And then, she told me, she started to break down, and she's like, I just need to know that what we put in place is still solid. Like what we have is good, and I don't need to worry. And I said, look, Paul did the right thing. He took care of you. He put this annuity in place for this day. Now, we didn't expect it to be now, and we had no idea, right? But luckily, he did. He put it in place. He was a smart man, a brave man, to take the steps needed to get this done. And he was wise, because he didn't know he was in bad health when he did it, but he did it for the what if, and here it is.
Yep.
And now letting her know that from an income perspective, her essentials are going to be covered for the rest of her life. It really gave her a lot of clarity and peace of mind. And my advice to her was, look, we have plenty of time to submit the death certificate and all of that and get these things in place. But really what you need to do is you owe it to yourself to mourn, because that's healthy. You don't need to be worrying about this. Or she was asking me questions about taxes, if I knew how to use TurboTax, because Paul did all the tax stuff. And I said, don't worry about that. You have till April 15th to get that stuff done. Don't worry about that. Just worry about getting your frame of mind in a healthy place and your heart in a healthy place. And the only thing that's going to allow that to happen is for you to mourn appropriately and not be frantic and worrying about all of these things that you really have no experience with, which is very uncomfortable. But the fact that the annuity is going to serve her for the rest of her life, when I told her that, it was like weight lifted off of her shoulders. And she knew that, she was part of the planning, but again, it's not of interest to her. So, she knew that there was something in place. She just needed affirmation that it was the right thing.
Right.
And I'm blessed to have had the opportunity to help Paul before this all happened, and to help Sandra with that.
Yeah, and this ultimately, in that time period that she's in right now, and so sorry for her loss, but that time period she's in right now, there's so many moving parts that she's got to consider, right? And the value point of her not having to worry about that annuity and its job and its purpose, one less thing for her to have to consider right now.
100%.
Yep.
So we talked about the different types of guaranteed income. We talked about the predictability, the stability, the peace of mind that having an income annuity can provide. Why don't we talk about the different types of annuities that provide guaranteed income, Zach?
Yeah. So as I was thought we were going into initially, different types of annuities would be the immediate income annuity, single premium immediate annuity, SPIA, call it what you will. You will hear different names for it. With that annuity type, primary purpose is a lifetime of income. It can be used for several different purposes, though. So whether that means it's a lifetime of income for an individual or joint with a spouse, can use it for that purpose. Can also be used for the purpose of a set period of time. Maybe somebody only needs this for 5 years or 10 years, and maybe that's bridging a gap for a certain number of years. But the immediate annuity goes way back in time, and for anybody today, it's serving that purpose of a lifetime of income or for a set period of time.
Yeah, the single premium immediate annuity, or SPIA, is the oldest form of income annuity. It was actually invented back or created back in the Roman times, and the Roman military used to pay their soldiers annua, which was yearly income. And the longer you served, the longer annua or income payment you received. And it's a very simple contract, right? Annuities are all about contractual guarantees, and the contractual guarantee of a single premium immediate annuity, or what else is referred to as a immediate income annuity, is that you have a contractual guarantee of income, whether it be for a lifetime, or you can even structure it for a certain period only, like Zach said, to bridge the gap or help you get to longer deferral of Social Security, whatever you want to use it for. You can customize the period of time that it's going to pay you. 4 years, 5 years, 7 years, 12 years, it doesn't matter. You can put in these contractual guarantees or structures of those guarantees and customize them to your liking or to your needs. In addition to that, you can have unique structures like single and joint life, either for you or for you and a spouse. And along with those lifetime guarantees, you can also add period certain guarantees on top of the lifetime, which are very interesting. And the way that structure works is that, let's say you structure it for joint life, and you also get structured a 20-year period certain guarantee. And what that 20-year period certain guarantee is going to do for you is that in the event you and your spouse pass away, since it was joint life, let's say you pass away in the in the 10th year of that contract. Well, that 20-year period certain guarantee is going to kick in, and the remaining income payments that are owed between the 10th year through the 20th year, the remaining years, in this case, it'd be another 10 years of income payments. Those are going to pass on and pay your designated beneficiaries in the contract. So this addresses one of the biggest misconceptions in the annuity world, and that is that if you pass away, the insurance company keeps your money. And that is simply not true. That only happens in one particular structure of an annuity. And that would be, in this case, a single premium immediate annuity that has life only. There's no period certain, or there's no installment refund or guarantee refund or a cash refund at all. So the other types of refunds to avoid insurance companies keeping your hard-earned money if you were to pass away earlier than expected would be to build in those 20-year or 15-year or 10-year certain periods, or instead of the certain periods, you can add in the installment refund or the lump sum refund. And the way that that works is if you put in, let's say, $200,000, and the insurance company's contract states it's going to pay you X amount of dollars per month for the rest of your life, and you don't live a long enough life to get back that initial 200,000 through those income payments, whatever balance is left over. So let's say you put in 200,000 and you've received $120,000 of income payments up to that point, and you pass away. Whatever's left, in that case, it would be $80,000. Depending on the initial structure, that $80,000 will be refunded to your beneficiaries either via a lump sum or through an installment refund, which would pay out in annual payments generally over a period of time. So regardless of what you need and what's important to you, we can build it and customize it to fit your situation. And I think that's where it's key, working with somebody that understands annuities and that can, more importantly, help you understand them and increase your annuity IQ so that you can make a good decision.
Yeah, and really to carry over what you had mentioned about some of the misnomer of an annuity and just losing that money to the insurance provider, that drives home the point of working with an advisor who knows what they're doing when it comes to retirement planning. And even oftentimes, and part of our practice is to share the information with all of our clients transparently. Part of our practice, we'll pull that up and do a side-by-side comparison of, is one more valuable than the other? And oftentimes we don't see that receiving an income without a benefit, without a death benefit, doesn't often pay very much more than one that does have that death benefit.
Yeah, and that's absolutely true. And that's where it comes down to working with somebody, like you said, Zach, that's an expert, but not only that, that they're an independent advisor where they have no allegiance or, reason to only work with one company or a handful of companies. They work with every company so that they can truly work for you and serve you to help you get the most value for your hard-earned money. And that's where also it takes a very transparent process so that you can know that to be true. Yeah. And that's something that we do here at Annuity Association. And as a matter of fact, if you're interested in really taking the next step at exploring annuities, or maybe you're already ready to buy and you've been thinking about this for a while and you're just trying to find the right person and the right firm to serve you and help you make a better decision, you can go to annuityassociation.com. And right there, to take the first step, you can request your free annuity report. And in that report, we will tailor, the annuity rankings according to what you deem to be the most important things to you, whether that be lifetime income or safe growth. You'll input your age, your investment amount, how long you're willing to defer the income before you activate it. And we'll be able to send you out a free report that'll show all of the companies on the independent annuity marketplace, rank them chronologically according to the highest benefit, whether that be income or growth. And that way you can get started and really delving into which companies and products are going to be a potential fit for you. And then if you're ready, or when you're ready, rather, you can also schedule a meeting with our team of advisors that obviously will put your best interest first. And I think that's another part of it, right? Is that making sure that that advisor is acting in your best interest. And here at Annuity Association, we are an early adopter of what's called the best interest standard. And it was model regulation that was put in place that gives us a fiduciary responsibility to solely act in your best interest. We don't put our interest before yours. Our goal is to earn your trust. And we do that through transparency and education, and really giving you the ability to compare and contrast all of the products to know exactly what's available, what you're looking at, how to disseminate the information appropriately to you to help you make an educated decision. And that's really something that we're proud of. But to get started, simply go to annuityassociation.com. We would be honored to have the opportunity to see how we can help. Absolutely. So we talked about that immediate income annuity. Let's talk about the cousin, right? The cousin to the single premium immediate annuity. And it's the same thing, really. It's just deferred, right?
Yeah. So direct relative is going to be that deferred income annuity. So we first hit on acronym being the SPIA, single premium immediate annuity, where that income is activated within the first year of issuing that policy. And then the direct relative is the deferred income annuity, or DIA. And that's where the income is then activated after a 1-year wait period. And then you can start that income at that point. But just a matter of that person's preference and their goal, what that timeline looks like, of what that need is for that income.
Yeah. So the deferred income annuity, or DIA, DIA, is basically this similar structure to the SPIA. The only difference is that you're electing to defer, and that's going to be contractual. So you're anticipating into the future when you plan to turn on the income, and all of those other features and structures and customizations of the SPIA apply to the DIA. You can determine if you want it single or joint life, period certain or no period certain, installment refund or lump sum refund. Same customizations, just the difference being a deferred income annuity is the income contractually being contractually elected out into the future beyond the first 12 months. So an immediate income annuity is electing income within 12 months. Deferred income annuities are deferring longer than 12 months. So you can go out into the future quite a bit. And then that'll bring us into the third type of annuity. This type of annuity is not really commonly used for lifetime income, but it can be used for some forms of income. And that is the traditional fixed annuity, or what we refer to today as the multi-year guaranteed annuity, or MYGA, MYGA. And the MYGA is basically a CD alternative, right, Zach? It's going to give you an agreed amount of interest at a fixed rate for an agreed amount of time. So think of it as a time deposit vehicle. For an agreed amount of time in the contract, the issuing annuity provider is going to guarantee a fixed rate of return on your assets. You're not relinquishing control of that asset. You're not, giving it up in any way, shape, or form. You're just giving it a fixed rate of return for an agreed amount of time. But this type of annuity, no different than any type of annuity for that matter, again, the word annuity being income payments, fixed annuities and multi-year guaranteed annuities can be used for income. The way that most people use them for income today is just taking that fixed rate of interest and taking that as a free withdrawal each year. So if you're getting 5.5% guaranteed interest, which is where we're seeing those rates right now, give or take a few basis points at the time of this recording, you can take that interest as a free withdrawal per year to supplement your income while keeping your principal whole. Another way, though, and since this episode is all around guaranteed income or guaranteed lifetime income, is that these MYGAs can also be annuitized. Now, annuitized is a term that's given when you're exchanging your contract value in return for a guaranteed income stream, whether that be, again, lifetime or period certain. But it's not very common that these fixed annuities or multi-year guaranteed annuities are annuitized. When you annuitize, you're relinquishing control of that account value. And it's not very optimal compared to other income annuity options on the market. And that's why less than 4% of all annuity contracts are ever annuitized. Really, it's not very common, since the next type of annuity is more common for lifetime income today than ever before. And it's because of some of the unique features that this next type brings. And Zach, why don't you take us into that fourth type?
Yeah. And I think we had talked about the fixed annuity or the MYGA before, and just the functionality of it and the value and the role that it can play. Oftentimes we're seeing those withdrawals come from earned interest, or maybe a little bit more, depending upon the carrier and what they allow for a free withdrawal. But most of the time we see this as obviously a guarantee, but a safe guarantee that comes with it. And yeah, to add to your point, really, we don't see this as the purpose of a guaranteed lifetime income vehicle. It's not there to serve that purpose. We're here to guide you if that is something you still want to consider. I've seen some clients use this for the purpose of funding a vacation annually, or just knowing exactly what to expect out of this product, and no market surprises that come with it.
Absolutely.
Now with the fixed index annuity, has the value to serve two purposes. One would be for accumulation, one would be for lifetime of income. And since we're focusing in on that lifetime of income, what we're seeing is the key word in a fixed index annuity is flexibility. The flexibility that we have with a fixed index annuity is the big value add that we have in a comparison to the single premium immediate annuity or the deferred income annuity. And with that flexibility comes a lot of features, and that's centered around that deferral period that we have. Also coming with the optionality to take out withdrawals. So it creates some leverage that we've got that other annuity options just don't have.
Yeah, that's really the cool thing about a fixed indexed annuity, is that it's a hybrid of sorts, where it incorporates a lot of the good features of the other types of annuities out there and kind of packages them into one product. And again, you're talking about the flexibility of a fixed indexed annuity, and I can't express more how, if you're looking for guaranteed income in retirement, there's no more powerful vehicle to leverage than the contract of a fixed indexed annuity with a guaranteed lifetime income rider. Those contracts, those lifetime income rider contracts, are pure gold when it comes to building a retirement plan into the future. So a common way that these are often used is for people that are entering that retirement red zone, when they're approaching that 10-year window of when they expect to retire. And they know that, losing any part of their nest egg at that point could be critical to the overall success of their retirement. It can really tell them if they're going to be able to retire, or maybe they're not. And to mitigate that risk, right? To mitigate that risk of potentially losing a significant portion of your nest egg in the event of a market downturn, and you're still invested at a high level of risk, you can risk off a portion of your nest egg, put it into a fixed indexed annuity with a guaranteed lifetime income rider, and still build that income benefit over the next 5 or 10 years, or however long it is in that 10-year window when you're ready to retire, and leverage the guarantees of those income rider contract rates. And right now, depending on the specific product at the time of this recording, we're seeing income rider rates on that income benefit value anywhere from 7 to 10%, depending on the specific product. And all of that is guaranteed contractually. It's not tied to the markets. Yes, it's an indexed annuity, and it does have some features that can grow the account value in a way that uses the indexes as a driver for that account value growth. But when we're talking about the income benefit value, that is where the contract of the income rider is going to grow that income benefit value at a guaranteed rate anywhere from 7 to 10%. And it's very, very powerful. Oftentimes you can get an upfront bonus on those income benefits. I'm not a big bonus guy. I think a lot of it's marketing fluff. So I want to just go ahead and put that disclaimer out there. But when it comes to looking at income benefit value and growing a pool of money that can then be used for a guaranteed lifetime payment in the future, it's a very powerful tool to help mitigate unfavorable sequence of returns risk over that 10-year window leading up to when you're retiring.
Yeah. And I'll tell you, between you and I think we both see situations with our clients where they may say, Zach, Jeremiah, I plan on retiring in 5 years, but what happens if I retire at year 4 or year 3, or wait till year 6? Well, again, this goes back to working with an expert in the field, because with the tools that we have, we can show you which options are your best solutions within that time frame. And maybe a handful of companies provide the optimal outcome that you're looking for based on that window of 3-year to 6-year retirement period. And we can find the right solution that best fits that need. But these are the questions that come up in the conversations of, hey, I don't know exactly when I'm going to retire. Well, that's okay. Let's try to game plan so we know what to expect if you do retire earlier than you initially planned.
Yeah, and I think that's important to note, right? Is, again, we keep talking about flexibility, and a lot of the people we speak to, like you said, they don't know exactly when they're retiring, but they have a ballpark range. A lot of times they're, doing contracting work or something, and they might be on a contract. They don't know if it's going to be renewed or what have you. But regardless, the flexibility in these income rider contracts is an amazing thing, because let's say we plan to retire in 5 years or 7 years, but something happens and you're forced into retirement earlier than anticipated. Rest assured that even though we did the planning for that 5 or 7 year period, if you need to activate it sooner, you absolutely can, and there's no penalty to do so. A lot of people oftentimes think, well, if I buy this annuity for a 7 years deferral, what happens if I need to activate it in 3 years? You can activate it. Most of these annuities in these income rider contracts, you can activate the income anytime after the first full year of the contract. The only difference is, obviously, since you're not growing it anymore and you're activating the income amount's going to be less. So the longer you defer, the more you're securing that guaranteed income rider roll-up rate that's building that income benefit value. And in addition to that, there's still those mortality tables that are playing in. Every year that you advance in age, the payout percentage of that total income benefit value pool is also increasing in most cases. So, but it's all about the flexibility and knowing that, hey, you're buying this income rider, which is a contract. It's a schedule. You're buying a schedule. You're buying a schedule of how much interest that income benefit's going to roll up as each year of deferral. You're buying the schedule of, if you activated it at this age or that age into the future, it'll tell you exactly the payout percentage that it'll pay. And it's all contractual. If you meet those schedule parameters, that's the income amount you're going to get. And knowing exactly what amount of income you're going to receive and when is so powerful when it comes to planning for the future.
Yeah, and that goes with joint coverage as well, right? So for the spouse to understand it and to understand that process while we go through it, we love to have the spouse with us, so that as we're working through understanding what those goals are initially, okay, let's play out those worst case scenarios. What if it does happen a little bit sooner than we initially planned? Well, now Tim or Joan or Pam or Joe, now they understand what to expect, and they're not caught off guard if life does happen to us and something does change.
Absolutely. Yeah. The joint life aspect is super important to that. And then, not to mention, again, we're talking about income riders on these fixed indexed annuities. They're not all created equal. So you definitely want to make sure that you're getting the best one for your particular situation. But the income rider, and that, again, that schedule that you're buying and how that income benefit grows and what the payout rate's going to be, it's such an important tool to mitigate one of the most, underspoken risks that we all face in retirement. I keep going back to that 10-year window of time when you're leading up to retirement, and even after you retire, the 10 years that follow. That's called the retirement red zone. And the retirement red zone is all about the the way that the markets behave leading up to retirement and shortly after you retire. And if you're invested in the markets and you're counting on that to grow your nest egg, which again is for most people their future income pool, that's what they're saving it for. If you have unfavorable sequence of returns during that retirement red zone, again, being the first 10 years leading up to retirement or the 10 years that follow after you retire, if you have unfavorable sequence of returns during those periods of time, you're going to be really in a tough spot if you have unfavorable market conditions just a few years left before you retire, because that's going to change the amount of money that you can count on to serve as a future income source. So if that happens, you're only left with two options. You're either going to retire with less money, or you have to spend less in retirement, or I guess there would be a third option, and that's to continue working longer than you expected so that you can recover from the losses. But if you, again, risk off enough of your assets, put it into a fixed indexed annuity with a guaranteed lifetime income rider, you can rest assured that regardless of what happens in the markets, and if the markets perform poorly, that guarantee in that income rider contract was growing that income benefit pool at a very competitive rate so that you can have an amount of money to count that you can count on. And that's something that I don't think people really understand enough, is that sequence of returns risk. And I think it would probably be a good time to go into a quick presentation.
Yeah, I was going to ask if you wanted to share that now or if you wanted to hold that for another episode, but we're talking about it now, so I'd love to see if we can include that.
Yeah. So basically what sequence of returns risk is not really talking about the average of returns over a period of time. It's more of how the returns unfold and what sequence they unfold in. So there's two market scenarios or market portfolios that we're looking at. We have an up market and a down market. And on my left, being the up market in the green color, you'll notice that both of these portfolios start with the same amount. That's $1 million, and the person is retiring at age 65. But he has annuities or other sources of income he can count on, and they're not really planning on taking any distributions from this account. And this is just an example to show you how sequence of returns works and how there isn't really much of an impact on the bottom line, and there isn't one at all if you're not taking distributions from this account. So in the up market, you'll notice that in the handful of years in the beginning, when the person retires, so the first 10 years or so, they have really favorable returns, double-digit returns in most of those years. And on the right-hand side, in the down market scenario, what they're doing here is they're taking the same exact returns and the sequence of those returns, but flipping them. And so in this example, in the down market, they're taking more negative or lackluster returns in the first 10 or so years, and then having the better returns on the back end of this 25-year period. And you'll notice at age 90, both the up and down market portfolios end with the same exact amount at 4.2 million and change. And the average return over that 25-year period was 6% in both scenarios. Again, remember, this person had income from other sources, whether it be annuities or Social Security and pensions. They had another source of income they could count on to where they were not forced to withdraw income from this market account. However, if you're like most people out there thinking that you're just going to maybe take income out of your brokerage accounts and IRAs and 401ks and navigate the unknowns with that approach, that's fine. But when you face a situation where you have unfavorable sequence of returns, it can have a severe impact on the life of that portfolio and how long it actually lasts. And it may have a shorter life than your own life, meaning you outlive the balance. And this is an example of showing what that might look like. So in the, again, up and down market scenarios, the up market being on my left in green, the difference is that this person now is relying on a 5% annual withdrawal from this $1 million portfolio. And while they're still getting the same, good returns in the earlier years, having a $50,000 draw now can still make an impact to the bottom line. And you see that being evident at age 90. Instead of 4.2 million at the bottom line, we have 2.5 million for this upmarket scenario. If we shift our eyes over to the right-hand side with the down market in brown, same thing, adding a $50,000 annual withdrawal or 5% of 1 million to service their income needs in retirement. But having unfavorable sequence of returns in the earlier years, remember, retirement red zone, the 10 years leading up to retirement, 10 years following your retirement date. If you have unfavorable returns or losses while you're taking income, look what happens to this year-end value. Ultimately, at age 82, that account is depleted to zero. So the impact of having a withdrawal while also having unfavorable market returns and the sequence of how those returns unfold can have a detrimental impact to your bottom line. And that's where it's critical to understand in order to navigate this type of risk, which is a very unknown risk. A lot of people don't think about it because we only think about the markets going up, 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 and we're never taking withdrawals, so we don't have to worry about it. It can be a game changer once you understand the risk that we face. And I think having a plan to mitigate it is so critical to the success of an overall retirement.
Yeah, a good example of what you just showed there on the case to the right was just that, a term that we use is you can't compound zero, right? So yeah, as we saw that account value decreased over time, you may have a return in the market, but if your balance is zero, that's not changing anything. You're not increasing that balance at all.
You're actually reverse dollar cost averaging it. Dollar cost averaging obviously is when you're just contributing a specific amount over time, over a long period of time, but you're doing that contribution consistently. And as the markets ebb and flow, you're buying in with those little increments at different points in time and averaging the cost over that period of time. Well, it's the opposite. When you're taking withdrawals and you're also in a negative market, you're selling more shares and compounding the loss effect on your portfolio because you're taking a distribution and selling more shares to get the same amount of income because those shares are now worth less in that down market. So it's actually compounding the loss, which is very detrimental to the success of that portfolio long term.
Yeah, and then that just brings us right back to the point of the value of that guaranteed lifetime of income and that what it provides, that having your monies in the market just isn't capable of doing. There's just no guarantee that comes with it.
Absolutely. So we talked about the role of riders and securing guaranteed income. We talked about those income riders on fixed indexed annuities. There is one other type of rider that I think is relevant to this discussion. There are a few different riders that you can have as part of those fixed indexed annuities. But when it comes to an income perspective, there is one other type of income rider, and it would be what we call an inflation protection rider. Zach, why don't you cover some of the details of an inflation protection rider and how it could potentially help somebody mitigate that risk?
Yeah, so with this rider type, what's going to happen is with that, the rider is going to adjust your annuity payments for inflation, actually. So your income keeps pace with the rising costs. In addition to that, it's really just a great way to ensure that your income maintains the purchasing power over time. What you're going to find as nature of what you'd expect, start out with a lower income that comes from that annuity, and then it will increase over time. So if we were to compare that to a guaranteed lifetime income with an income rider, a fixed index annuity with an income rider, that income will start lower with that inflationary protection rider.
Yeah. So because, these income annuities and the way that the amounts are determined are based on life expectancy from those mortality charts and some other factors, there's only 100 pennies in a dollar. So if you're expecting this income to rise contractually from an annuity for inflation, it's obviously going to start at a lower amount. And for that reason, to be fully transparent, I'm not an advocate for inflation protection riders or any of the sorts. You can even add cost of living adjustments on single premium immediate annuities. You can have it customized anywhere from 2 to 5% contractually. But what happens is when you elect to have those riders or those customizations for cost of living adjustments over time, that the initial payment that you begin to receive is going to be far less than when you if you were to activate the highest fixed level payment you could secure at that time. And so there's going to be a break-even point of how long it's going to take for that inflation adjustment income to reach what the highest level income would have been out of the gate. And oftentimes it's a longer period of time than what really makes sense. And so if you're looking at, addressing inflation, you shouldn't be looking at the annuity to do it all. Like it's a great product. It's a very powerful tool, but it's not really a Swiss Army knife that can do everything really well. It's used to do what it does do really well, and that is secure guaranteed lifetime income. And you should be securing that guaranteed lifetime income with the highest level fixed payment you can secure, and then use the other parts of your planning tools to address inflation. So a quick example of that would be, again, securing enough assets and putting them into a guaranteed income plan between your Social Security, a pension, if you're blessed to have one, and the guaranteed income annuity at the highest level fixed payment you can find. And then using other assets that you have to address inflation. So it could be simple as, buying CDs and using the interest from the CDs to give you a little bit of a bump every year. Or if you have those market accounts, which you definitely still should if you have the tolerance for risk at that point in time, you should have market accounts. And when the markets are doing well and you have a good return in the year, take a few points off the top and use that as your inflation buffer. And what sometimes I have clients do, is that when they have a good year in the market, earmark a percentage or two of the return and put it into a fixed rate asset from that point on. And they're building an inflation bucket separate to their general income bucket, right? We talk about buckets a lot. There's 3 main buckets in retirement planning: your income bucket, your growth bucket, and then your legacy bucket. Income bucket is your Social Security, your pensions, and your income annuities that are guaranteed to cover your essentials. Your growth bucket is then used to grow your assets over time. It can be used for leisure expenses in the future, but then it can also be used for inflation. That's that growth bucket. And then last but not least, that legacy bucket. If you don't have a legacy, you can change the name of legacy to long-term care bucket, because you might need that one day. And but you have to build those buckets incrementally and do them by compartmentalizing your money and piecing off enough in each bucket to address your goals and give those buckets those intended purposes.
Yeah, and ultimately it's up to our clients to decide what risk factor goes into that growth bucket, right? So it's up to that person's discretion. If you feel that the income bucket has been handled, the legacy or long-term care bucket has been handled, then that's up to that person to decide, what they're willing to risk.
100%. And that's going to lead us into our next segment, which is our supporting research. We're not just coming and shooting from the hip with this stuff. We are subject matter experts here at Annuity Association. Annuities is all that we do. You can call us a one-trick pony, if you will, but I believe in financial planning, that's a good thing. A lot of advisors out there, they wear many hats and they try to do, in my opinion, too much, and they try to become an expert of too much. And, what's that saying, Zach, is like a jack of all trades is a master of none.
That's it. Yep.
And it's oftentimes, and the only reason I'm saying that, I'm not saying this to demean anybody or put anyone down, because I know there's a lot of very intelligent and really good advisors that mean well, but they try to do too many things around the areas of financial planning that they're not experts in most of them. And when we talk to somebody and we start to hear their story and what they're looking for, and oftentimes they've already spoken to an advisor or two, it's very easy to hear that they're obviously already working with someone that's not an expert because of the products they've been pitched or what they've been told or shown. And I think that's where it comes down to understanding that an expert is going to back up their claims with research from very powerful testimonies. And that leads us into our next segment, which is really looking at the research that supports the idea of guaranteed income overall improving retirement outcomes. And experts like Dr. Wade Pfau and Dr. Michael Finke have studied the impact of guaranteed income on retirement security. And with Dr. Wade Pfau being the professor emeritus of the American College of Finance, he's done some extensive research on the benefits of annuities in creating sustainable retirement income. And, he really talks about not only the economic impact in a positive way that an income annuity has on somebody, but he also talks about the psychonomic benefits to that people get from the peace of mind, and that it helps them make better decisions in the future with their money because they have the big risk already mitigated with the foundation of lifetime income. And he breaks retirement planning into retirement risks, and then he designates different tools to mitigate those particular risks. And he ties the income annuity to two main risks that are really essential to determining your outcomes. And that we talked about one of them being the sequence of returns risk. And then the second one, which is the multiplier of all of the financial related risk that we face in retirement, and that is longevity risk. Longevity risk is that retirement risk multiplier, because the longer life that you live, the higher chance you have of facing the other retirement risk. And we're talking about investment risk, taxation risk, geopolitical risk.
I'll call it what it is. It's just the risk of running out of money.
At 100%. It's the risk of running out of money, 100%, or, the risk of not being able to spend your money freely
Right.
that you could have if you had an income annuity, right? And so that's a main issue that worries many retirees. But the predictability of those income payments that the annuity creates really allows you ultimately to free up other assets for growth potential and helps you optimize your overall retirement strategy. So I really commend Dr. Pfau. He's a genius, definitely an expert. And the thing that I love about him the most is that he's not biased. Like, he's looked at everything, and he doesn't work for an insurance company. He doesn't have an annuity license or insurance license to sell annuities. He's really just trying to help people. And I think that he understands that there's a significant amount of bias in the financial planning world. And he's trying to rule all of that bias out and debunked a lot of the BS that comes with those bias.
Yeah, no, absolutely. I mean, for each individual person, it's all going to be something different and what they see. But ultimately, if the research supports one element of that financial planning, there's merit to it. And again, the approach that we take is we're here to help you out with serving the purpose of some guarantees in your retirement.
Yeah, and that's the thing, is the guarantee. And really, Dr. Finke also talks about, when he reinforces the idea of emphasizing guaranteed income, and that it's ultimately to help lower the need for risky asset management in retirement. He really points out that securing part of that retirement income with a predictable stream from an annuity, retirees are going to reduce the pressure on their remaining assets so that those assets can truly perform, allow them to grow, and do so more safely over time. And by removing the need to withdraw income from those assets that are in the markets or in other investment vehicles, it allows them to benefit from a longer compounding effect over your retirement horizon. So if your goal, right, and I'm speaking to this because I talk to a lot of people every day about this stuff, and they all want to have this income, and they all want to have this nest egg that they either pass on to loved ones or a charity or what have you. And if that's you, seriously, if you think about the income annuity serving as an optimizer to that growth part of your plan so that it can just grow and compound over time, no different than it has during your working years, you're going to really see the value in it. Think of it this way. When you're working and you're getting that paycheck every week or every 2 weeks or however often you're paid, and you're investing and contributing to your 401ks and IRAs and brokerage accounts, time is on your side, and you have those paychecks from your employment to allow you to contribute and grow your money safely, or not safely, but over time without having to think about it. The income annuity is replacing the paycheck in retirement. So it's still giving you the same frame of mind that you had during your working years. You're still getting that constant paycheck and cash flow to serve your lifestyle needs. And then you're being able to still grow that nest egg no different than when you were working, because you're not having to look at it with a mindset of preservation. You're able to still look at it with a mindset of accumulation. And that's super powerful.
Yeah, and that brings us really right into really our final segment of just choosing the right guaranteed income strategy for a person's needs. And how do you make that decision? How do you choose the right guaranteed income strategy for somebody's needs? And it's really just all about understanding one's goals and priorities. And that's a time that we take with any of our clients. And ultimately, it's looking introspectively and within yourself and understanding what risks you're willing to take, what you're not willing to take, and do you want lifetime income? Do you want protection against inflation? Are you comfortable with these market risks? These are all elements in that consideration of understanding your goals and priorities.
Yeah, and I think everybody is a little bit different in what really they want and need. And there's different approaches to all of this. But there's only one approach to do so with guaranteed income. So if you like the peace of mind and the clarity and confidence, and again, optimization really that the annuity can provide now and long term on your overall assets, it's definitely something to consider. And guess what? We're not asking you to only use an annuity. We're suggesting that if you identify with being a little bit more conservative and you like the idea of consistency and predictability and peace of mind, like there's no other vehicle better for that than an annuity. And it's going to come down to knowing the proper approach. A lot of the people that work with us, they're not looking for a full financial plan. They kind of are more do-it-yourselfers in most cases, where they already have a plan in mind, and they have a spreadsheet sometimes, or they have their ducks in a row from most of the pieces of their puzzle, right? They already have all of those pieces. They're just trying to find one more fit. And sometimes that fits the annuity. And guess what? Sometimes the people we work with already have an investment advisor that manages their brokerage accounts. Sometimes they already have an estate planner and all these other pieces of their financial counsel, which is critical. But what we find is that those people are looking for a subject matter expert in annuities to help them put that last final piece into the puzzle. And that's where we come into play. And so with that being said, Zach, what are some things when somebody is evaluating an annuity advisor, how do they determine if they truly are a subject matter expert? What are those things that they're going to need to hear and feel when evaluating, that person?
Yeah, I think the first thing is understanding where that client is really coming from and what they intend to do. For me to just throw out projections of what I think somebody should do prior to understanding that person and what's important to them doesn't add any value. It doesn't help them in any way. If somebody can come to me and confidently say, Zach, here's what I've got. Here's what my plan is. What do you think? I'm willing to provide my opinion. Until I understand what that person's goal and mission is, my opinion doesn't mean anything. So I think, first of all, it's understanding what that person's intent is, whether that's nearing retirement or at retirement. I think it's also worth understanding the differences between a financial planner what accessibility they have to the annuity marketplace, and what a subject matter expert has at their fingertips, like what we have at our fingertips, and the tools that we can use that makes us unique, in my opinion.
Yeah, I think you're so good, Zach, at really understanding the person on the other end of that Zoom, right? Working in a remote capacity and meeting with people from all 50 states. I think you do an amazing job at like understanding what matters most to that person on the other end of that Zoom meeting, and hearing them out and being a good listener and being able to understand what's important to them and what they're feeling at that time, and really what they're thinking about doing in the future, or what needs to occur in order to feel that they made the right decision. It's very often that you'll have, a full meeting, which is generally an hour or so, without ever talking about products, right? You're more about a discovery and really an exploratory session to see what is it that I can help you with and what is important to you. And that's really, I think, what you do an amazing job at. And I really want to commend you because I really love reading our Better Business Bureau reviews, and you have a ton of them on there, 5-star ratings across the board about how tentative and how you were such a good listener, and that you really put people's needs first, and that you were able to put them at ease as well in such an important decision. So I just want to tip my hat to you, because it's rare that you can do that at such a high level. And these days, with how many people are out there and how many people that everyone's speaking to, and the fact that you're able to put that first, it really says a lot about your character.
Well, I appreciate that. And ultimately it's what we've built here at the company, right? So while my name may appear there on the Better Business reviews, we've also got to commend everybody else, everybody on our team, because ultimately sometimes those names don't show up for however they filter that. But there's multiple names that we see there across the board on our team that are getting these great reviews as well. And that all comes from top down.
I appreciate that. It's about the culture, man. That's really what we wanted to do at Annuity Association was, we're on a mission to right the wrongs of this industry and to ultimately help people make better annuity buying decisions. And we do that by creating a better annuity buying experience. And that starts with our advisors and the training that they go through, and the expertise that they're to attain before they can start taking these important meetings, dealing with people's life savings. I mean, it's something that we take very serious. So, it's all about the culture that we instill here at Annuity Association. And, like I said, and I think on our past episode, I would put us against any other annuity firm out there when it comes to the quality of experience that people are going to get and the result that they're going to get with us. And it's not just a one and done deal. We're very proud of our annuity assurance program, which when you become a client, it's not done from there. That's only the beginning. When your contract gets put in place, we're going to meet with you every single year, assess your needs at that time, do a review of your current policy, look at the performance, look at the all of the other features and benefits of the product, give you a refresher of what it is that you have, since these can sometimes be complex and get forgotten about in a way. So we're going to give you that quick refresher course every single year and help you get the most out of your annuity, and also help you maintain it. So if you need to make changes, whether it be the index allocations, if it's an indexed annuity, or if you need to make an income election or withdrawal for RMDs, we're going to hold your hand and make sure that that's done so in an efficient way, and ultimately be your liaison between you and the insurance company itself, so that you don't have to deal with long hold times on the phone or deal with pesky paperwork. So with that being said, if you'd like to give us a shot, maybe you're exploring annuities for the first time. Maybe you already own an annuity and you're looking to buy another. Maybe you're working with someone else out there that, you're just really trying to test the waters and get a well-rounded approach, which we highly recommend you do. We'd love the opportunity to serve you And to get started down that path with us, it's simple. You simply go to annuityassociation.com. Right there on the main page, you're going to click the button to request your free annuity report. That is going to be the most detailed annuity report on the market today. It's going to give you all of the carrier names, the product names, the rates, the fees, if there are any, the income amounts, if it's an income quote. We start with transparency. We believe that that's the first pillar to establishing trust. And we want to earn your trust. And we do that to start off with that transparency. After that report, if you'd like, the next step is simple, just to book an appointment when you're ready. Again, annuityassociation.com, and we'll get a Zoom meeting booked with one of our subject matter experts on annuities and help guide you down the path of understanding so that you can ultimately make your own important and educated decision. So we appreciate that. But that's a wrap up for our episode 2 of the I Love Annuities podcast. At the end of the day, securing guaranteed income, again, is all about peace of mind. And you want to know that when you retire, your income will keep flowing and that your lifestyle will be protected. And no matter what happens with the stock market or inflation, annuities are always going to be a good tool to help you achieve this. And by choosing the right type of annuity, maybe adding the right riders and ensuring that it fits within your overall retirement plan, you can create a financial strategy that provides the certainty that you need in retirement. That's it for today's episode of the I Love Annuities podcast. We hope this helps you get a better understanding of how to create guaranteed income and secure your retirement future. And if you, again, have any questions, you can visit our website at annuityassociation.com. We appreciate you tuning in, and we look forward to serving you on the next episode of the I Love Annuities podcast. This is Jeremiah Conger and Zachary Van Ness, the Annuity Dudes, signing off. Take care of one another. Have a great day. Let's hit that rock music, Zach.
Get it.
Have a good day. I can't help it.
You gotta play them. You gotta.
Where's your guitar, man?
I'm gonna get a headband next time. Yeah, hold it high.
All right, man.